learn from it, and I just read hundreds of books.
And one in particular, The Intelligent Investor by Ben Graham.
That book changed my life.
Because?
I finally found a philosophy that made sense.
Can you sum it up in terms that I would understand?
It really says that a stock is a piece of a business. If you buy a piece of a good business and somebody's running it for you and they're honest and able, and you pay a reasonable price, you're gonna make a lot of money.
Then Phil, I worked for Ben, I went to school under him, and his, what I call the three basic ideas that underlie successful investing, which is to look at stocks as businesses and to have the proper attitude toward the market and to operate with a margin of safety. They all come straight from Graham. I didn't think of any of those. And
The Intelligent Investor. The Intelligent Investor is by Benjamin Graham, who is not only seen as the father of value investing, but, for good measure, was also Warren Buffett's mentor. One of the two most celebrated books he wrote on the subject, the other being Securities Analysis, The Intelligent Investor, still strikes a chord with investors today, despite the first edition being written almost 70 years ago. That said, the book is perhaps less for people seeking an introduction to value investing, as for those already familiar with the discipline, who want to hear from the man who did so much to shape it. As ever, rather than offering a traditional review of the book, we will instead touch on the lessons we personally took from it. So what were they? Lessons from the book. 1. Process. Investors need a sound intellectual framework for making decisions, and also the ability to prevent their emotions from corroding that framework. This is actually an observation from Buffett's preface to the 4th edition of The Intelligent Investor.
I have some doubts about whether it can help you outperform the market, but it can certainly help you stop underperforming the market. And in truth, that's the problem that most people have. Outperforming the market is really tough. Even really high-performing hedge funds only outperform the market a little bit. As a retail investor, that's a really tough call. But actually most people who are managing their own portfolio, investing their own money, throw away returns because of their own psychology, returns that they could have got just by buying the market and sitting and holding it. I'll come back to, because I talk a lot about the importance of effectively managing your emotions and it not being the same as not having any emotions. But that big thing for many, certainly inexperienced investors, and to some extent for experienced investors, is getting blown off course from your strategy by the strength of your emotions. So being able to manage your emotions effectively is really important. And what's the single most important thing you can do to manage your emotions effectively? My view, don't speculate with money you really can't afford to lose.
2. Market behavior. The more irrational the market's behavior, the greater the opportunity for the disciplined investor. 3. Value and price. The future value of every investment is a function of its present price. The higher the price you pay, the lower your return will be.
Famous lesson about a margin of safety, that you don't drive a truck that weighs 9,900 pounds across a bridge that says limit 10,000 pounds, because you can't be that sure about it. If you see something like that, you go down a little further down the road and you find one that says limit 20,000 pounds, and that's the one you drive across.
4. Margin of safety. No matter how careful you are or how disciplined your process, the one risk no investor can ever eliminate is the risk of being wrong. Only by insisting on what Graham called the margin of safety, never overpaying for an investment, no matter how exciting it may appear to be, can you minimize your chances of making a mistake. 5. Your worst enemy. As an investor, your principal problem, one might even say, your worst enemy is likely to be yourself. 6. Future projections. Mathematical valuations that are dependent on anticipating the future and less tied to a figure demonstrated by past performance are more vulnerable to possible miscalculation and serious error. Unfortunately, a significant part of the value of a high multiplier stock is derived from future projections, which, except perhaps in the growth rate itself, differ markedly from past performance. 7. Bargain issues. Can one really make money in bargain issues without taking a serious risk? Answering his own question, Graham writes, "Yes, indeed, if you can find enough of them to make a diversified group, and if you don't lose patience if they fail to advance soon after you buy them. Sometimes the patience needed may appear quite considerable." In our previous edition we hazarded a single example which was current as we wrote. It was Burton-Dixie Corporation, with stock selling at 20, against net current asset value of 30, and book value of about 50. A profit on that purchase would not have been immediate. But in August 1967 all the shareholders were offered $53.75 for their shares, probably at just above book value. A patient holder, who had bought the shares in March 1964 at 20, would have had a profit of 165% in 3.5 years, a non-compounded annual return of 47%. 7. Contrarian thinking. The intelligent investor understands a stock becomes more risky not less as its price rises, and less risky not more as its price falls. By the same token, since it makes stocks more costly to buy, you should dread a bull market. Conversely, and so long as you keep enough cash to hand to meet your spending needs, you should welcome a bear market as it puts stocks back on sale. 9. Look beyond yield. Stocks do well or poorly in the future because the businesses behind them do well or poorly and for no other reason. As such, no matter how desperate they might be for income, no intelligent investor would ever buy a stock on the basis of its dividend yield alone. The company's underlying business must be solid, and its share price must be reasonable.
Tesla, as a publicly traded company, is selling at 70 times earnings. Meanwhile, Mercedes-Benz, which now produces EVs, is selling for 6 times earnings. Why should I invest in Tesla rather than Mercedes-Benz?
I actually rarely try to convince anyone to invest in Tesla. And many times I've recommended people don't invest in Tesla, and I've said our stock is too high, but then people just ignore me and keep buying the stock. And no one is even close to Tesla for solving autonomy or generalized self-driving vehicles. The car becomes, call it roughly 5 times more useful, but it costs the same to build. Then there's also the Optimus program, which is our humanoid robot. Now, the economy is fundamentally GDP per capita times capita. If you no longer have a constraint on capita because of a useful humanoid robot, it is not clear that there's any limit to the size of the economy.
10. Sources of undervaluation. There are 2 principal reasons why the wider market will undervalue a stock: currently disappointing results and protracted neglect or unpopularity. As such, Graham writes, an investor should require an indication of at least reasonable stability of earnings over the past decade or more, plus sufficient size and financial strength to meet possible setbacks in the future. Such considerations form a significant part of our own investment process.
When you have, during this period of economic growth and period of the success of Templeton Investments, the philosophy was always to buy bargains.
That's right.
How did you determine bargains?
Lowest in relation to many factors, but the biggest factor is earnings. How low is it in relation to earnings? How low in relation to growth trend? How low in relation to dividends? How low in relation to book value? How low in relation to competitors?
So you would look at comparative numbers, and if most of the companies were selling at 20 times earnings, and you found one that you thought had some quality was selling at 10 times earnings, you'd buy that one.
Yes, well, the differences were much greater than that.